Kraft Foods is a company that is down 70% from its peak at $90 a share. It's currently trading at $30 a share. I'm going to go through the financials in Kraft tonight, and I want to walk through and talk to you a little bit about how to spot a company in very poor financial conditions and why, in some cases, just because the stock has fallen doesn't mean it's a good buy. Let's go through kind of the key factors here you can look at to uncover exactly why this company has suffered so poorly and why management's making a poor decision by continuing to pay out dividends rather than the financial discipline you'd like them to see, taking the hard choices, making the cuts today for a brighter future. Ready? Let's get to work. Okay, first things first, who is Kraft Heinz and how did the company come about? Well, it was a merger from Kraft Foods and Heinz in 2015. Warren Buffett had a large position, I believe, in Kraft, merged the businesses along with C3 Capital to create Kraft Heinz Food Company. Let's take a look at the brands that they own. They own, obviously, Kraft and Heinz, the two bigger names, but then they own Oscar Mayer's, mac and cheese, Classico, Velveeta. They own Capri Sun. They own Kool-Aid, Jell-O, Golden Circle, Philadelphia, Grey Poupon. These are, global brands. They are very large brands. And when I read that name, just personally, when I look at that, I think of them as very old and outdated brands. That does not look to me like the portfolio that I would really want to own for the next 20, 25 years. That's not the brand that I would think we really would want to own. So I think they've got some issues with the staleness of their portfolio. They need to go out and acquire new brands. You look at companies like Estee Lauder, which is constantly acquiring the new and upcoming trend to kind of keep them fresh. Maxwell House here, they also own Maxwell House, Kraft and Heinz does. And that's honestly some of the worst coffee I've ever had in my life is Maxwell House coffee. It's disgusting. I don't think they serve it to Army soldiers. It's that bad. But here, nevertheless, it's in their portfolio. So let's see what's going on with the company. I want to look at their most recent report. They just reported their 10K. Let's take a look at the earnings release for Kraft Heinz fourth quarter, full year 2024 results. Net sales decreased 3%. Organic sales down 2.1%. Gross profit up slightly. Operating income decreased 63%, driven by $3.7 billion non-cash impairment. That's a big theme. Post-merger, the last decade, I think they've written off something, don't quote me on this, something to the order of $20 billion of impairment charges. Now that's goodwill, that's intangibles, that's goodwill that they put on the balance sheet years ago because they bought some company, and the underlying assumptions around that merger, which the auditors test every year, the growth assumptions, the synergies, the profit they're going to get from the deal didn't pan out. And when that doesn't pan out, the auditors force the write down because that asset is now worth less than what they thought it was, or the carrying cost, hence the write down. It's a non-cash charge, so you can add it back for things like EBITDA and adjusted free cash flow. But it does point to is an inability of management to identify and properly negotiate deals. And ultimately, this is capital that's being squandered by the corporation. In this instance, this year is $3.7 billion, but if you look back historically, it's been north of about $20 billion over the last decade, and that's a lot of jack to go missing. Diluted EPS is down. Cash provided by operations $4.2 billion, which is true. It was up. Free cash flow, that's fine. And return capital stock to shareholders $2.7 billion. I'm going to show you why I think that's an absolute mistake. Let's see. There's a quote here from the CEO. Although 2024 was a challenging year with our top line results coming in below expectations, we remained disciplined in protecting profitability while driving industry-leading margins, generating strong free cash flow, returning $2.7 billion to stakeholders. Now, I think that is incorrect. And I think that the CEO here is trying to defend the stock from falling any further by specifically calling out $2.7 billion of capital stock being returned, basically dividends. But I think that's disingenuous because he's ignoring the staggering amount of leverage that this business has on it, and really should be paying down that debt rather than bragging about paying a dividend that they can't afford. But we'll get there in a second. Let's take a look at operating results really quickly before we dive into the 10-year financial review. So what I want to do here is regional breakdown. Here's your net sales. This is 2024 full year versus 23 prior year growth rate, price movement, and volume and mix change. So what I want to do is just look in this column right here, growth rate. North America down 3.6%. Volume is down 4.5. The only reason it wasn't down 4.5 is they raised pricing. International down 4%. Pricing flat. Volume down 4%. Emerging markets up 2.2%, but volume is down 2% only because price increase. Craft itself 3% down year-over-year growth. Price up 1%. And volume was down 4.4%. So remember what I said about the tired and old brands? I think the fact that their volume here is declining year over year is a major problem. Inflation's 3% right now. So you'd expect some price movement just for inflation. I don't think they couldn't really do that in North America. So their pricing power is weak and they're losing volume. I think that's very concerning. Let's see if anything else on here. No, let's go to the cash flow one pager and dive into the details. Okay, before I dive into the cash flow one pager, I want to review the 5 key attributes that we use at the channel to kind of underpin an investment that's worth further consideration. Those 5 are as follows. Number 1, top line revenue. You want a company that can grow revenue year over year for a decade. You can have down years, but in general, it should be going north. EBITDA or profitability, you can use operating income, you can use EBITDA, which has its own problems, but the point here is you want enterprise level earnings to be growing, not earnings per share that has different issues. You want the company itself to be able to grow its total earnings over time. That's just the second objective. Number 3 is strong free cash flow. Free cash flow should be able to pay for CapEx, your dividends, all that stuff. Number 4, low debt. You want a company with less than 3 times debt to EBITDA. I'll get into that later. And number 5, you want a stock that's well priced. With some simple assumptions, long term, you should be able to beat the market, which is about 10%, or whatever your hurdle rate is. If you want 12% of your money, it should be 12, 15, 15. But for you, that's what that metric means. Okay, so here we are, the cash flow one pager. Heinz, ticker KHC. These are dollars in millions. Let's take a look at revenue. So revenue the last decade, it's basically, it's up from $18 billion right after this is pre-merger. $18 billion is just the Kraft number. $26 billion is the post-merger full year reported number. And that's actually down if you fast forward 9 years to 2024 to $15.8 billion. I've reset my average CAGR here to be a 7-year CAGR to give a couple years post-merger to see if they were able to grow through the pandemic. So take the averaging on the sheet and take the CAGR as a 7-year number. I didn't go back to pre-merger. I thought it was a little too wonky of data. But nevertheless, you can see here it's really flat. That's not a growing revenue. That's not going to check the box for us. EBITDA over this period of time, if I were to pick up the 7 years, it looks like it was negative because there was probably a large write-off here. But in general, they were kind of in this $4.5 to $5 billion range. Last year, they printed $2.7 billion. That's after adding back the impairment charge. I'd like to see that number come up higher, but I think they are struggling with that. I don't know, with declining unit volume and struggling year over year top line revenue growth, how they're going to get back to $4 or $5 billion of cash flow. We'll have to wait and see there. The big one here for me is debt. They have $20 billion of outstanding debt on a $2.7 billion EBITDA. That puts the debt ratio at 7.4 times, and I think that is far too high. They need to be down to 3 times or less. It looks like they've kind of struggled above that number their entire history. This debt ratio is too high. In terms of cash, they have about $1.4 billion on cash in the balance sheet. But for a company this size, with this much leverage, that's actually too little cash, in my opinion. And I'm marking excess cash here 0. That means market cap is $37 billion, down from a peak right immediately post-merger of $107 billion. So that is what, 60, almost $70 billion of value that has been eroded as a result of this merger and its inability to execute on kind of basic consolidation move between two mega brands. That's should have been a much easier win, but this deal has cost investors $70 billion in market cap. Enterprise value, just market cap plus debt, which gets the same result. Adjusted free cash flow. This is cash flow from operations less stock-based comp. They have very little stock-based comp, so it's essentially the cash flow from operations. You'll notice here that 24 cash flow from operations, $4 billion, and EBITDA is 2.7. The difference here is deferred tax liability that's being paid out. This cash flow number would have been slightly higher had they not paid off that liability. But it looks like to me they pay a lot they're paying down this deferred tax liability over time, and so I think that's going to be a continued cash outlay. I don't expect that to spike anytime soon. But in general, this number has been up. But in general, this number has been up over this time frame, up about 8% in the last 7 years, which is okay. Mid-single digit growth, fine. But the EBITDA number really went the wrong way. You can see in 2023, EBITDA declined from $5.5 billion to $2.7 billion, while cash flow increased from $3.8 billion to $4 billion. So remember I talked to you about when cash flow from operations and EBITDA go in different directions? Don't really like that. So for me, that's kind of like a pause button. I really want to see what 2025 operating results look like. I'd love to see them pay down their debt before you ever kind of touch this stock a bit more. CapEx is $1 billion. Okay, they can afford it. That's fine. And debt payment was very little last year. They did not pay down much debt year over year. They kind of stopped. You can see the last 3 years running, they've had $20 billion of debt. They really don't seem all that concerned with paying down debt. So free cash flow instance is someplace between $3 and $2.5 billion, someplace in that metric. They have 1.2 million shares outstanding, not really buying back shares. So that's not something we look for. In terms of free cash flow yield, you're looking free cash flow per share, $2.13 or $2.49. Average price 36 versus 30, so you're looking at a cash flow yield of 5.8 to 8.1. I think this line here is really what's attracting people to the stock. You've got 8% free cash flow yield. So again, that's before they pay dividends, before they buy back stock. There is cash here. It is climbing. I do like that. I will give you that. I like that cash flow. My problem here is the debt, the inability to grow revenue, and the declining earnings. I think that gives me a pause on this, and how sustainable is that really if over time they're unable to grow earnings. That puts that cash really at risk to me. So I'm not sure how long you can rely on it. In terms of how to forecast this business, I really honestly don't know. I took a guess here at some numbers. I just said, hey, take the EBITDA and let's assume it can go north, because it has to grow for this to really pan out. They've declined last year. Let's say long term they can target 3.6 billion of EBITDA, kind of get back up. Really not even where they used to be, but just move the number up $1 billion a year. Give it a 14 times handle on the multiple. That 14 comes in over here. You can see kind of post-pandemic, post-merger, they're in this 14 range. I said that's a reasonable number for a company growing at 3% for 14 times. Debt, I bought down debt, so I'm showing 9.1 billion in debt. I'll get to that in a second. But that gives me basically a price target of $34 and change. They're at $30 now. So from an EBITDA perspective, if they're unable to grow higher than 3% a year, you have a problem. If they got this back up, 6%, let's just say they did 6% for this duration of time, that's only 4.8 billion of growth. That's too high. If they did 5.8 billion, so we get back up to their peak EBITDA in 2023, 5.5. So at that, if they get back to that peak EBITDA, that's basically $60 a share, which is doubling from here. But they really got to go do that, and I'm not sure I'm willing to make that bet. Bet on those specific brands and the track record that I'm seeing. So I don't want to bet on the growth. I'm going to give it a very low growth target and have the stock price come to me to warrant locking my money up in a company that has no revenue growth and is struggling to grow EBITDA and whose cash flow and EBITDA aren't lining up and has a lot of leverage. So onto the leverage, what do we do with this? So how do you think about forecasting this leverage? Well, for us at the club, right, we want low debt as a hallmark of a business we're going to invest in. So in order for us to invest in it, we need to believe that they can pay down the debt. And the way I do that is as follows. I build a very simple forecast, super simple, high level here. But I take the EBITDA forecast that I showed you earlier. I assign a max debt ratio of 3 times. I get a max debt amount here annually based on the EBITDA. I then look at the current debt position that they have at $20 billion, and I come up with a buy down amount, an amount that they have to buy the debt down in order to limit the debt to the maximum amount. So if they can only afford $8.4 billion of debt, but they currently have 20, they got to buy down $11.7 billion of debt. Well, they don't have that money. They only make $2.8 billion a year in EBITDA. So I'm going to say, I want all that EBITDA. It's going to go to pay down debt, all of it. That means zero free cash flow for that year. That brings debt down to 17. I do it again. 14, do it again. 11, do it again. 9. And 9 matches the maximum debt amount. And so I can unlock the free cash flow for the EBITDA that they would then generate. So I can come out here and say, okay, free cash flow, less CapEx, EBITDA, less CapEx, free cash flow. There's some assumptions there. I get it. This is high-level math. EBITDA is not operating cash flow. I understand. Just trying to give you a gauge for what has to happen. Free cash flow of $3 billion. Now that debt's been right-sized. Okay, I'm okay with that. Shares, 1.2 billion. That means I get $2.59 of free cash flow. The problem is I got to wait 5 years for that. So when I tuck this into our cash flow forecast, come in here to the cash flow forecast, right? That's basically zero cash flow for 3 years while they're buying down debt. Then it starts unlocking cash, and long-term, $3 cash flow, fine. Put a 5% yield, $60 stock. Okay. If you change this back to 5 billion, this cash would probably add another $2, $2.50. So it might be 5.5. And then it's a $100 stock if they can get cash. Now that might be worth it, a $100 stock, if they can get the EBITDA back up to about $5 billion. At the $5 billion level, the debt right size, that's 15 billion of debt maximum. They have 20, they got to pay down a little bit less. So you get your cash flow back faster. The company would be worth a whole lot more on an EBITDA market multiple and a free cash flow multiple. So I think this stock really hinges on their ability to grow EBITDA through operational cuts, synergies, what have you, growing the output, the volume, price increasing. But I don't really see how they're going to do that. So for me, I think there's too much risk on this table, and I'm going to hold off. If I put this into a discounted just an IRR format, so here's the cash flows. I buy for 31, I sell for 47. 47 being the average of this 60 here and the 34 here are the two different methods. I get a 9% IRR. That to me is too little for the risk you take by locking your money up in this investment and having to wait for them to slowly, very, very slowly, grow their EBITDA or free cash flow. So I would watch these guys quarterly. If quarterly it looks like volume has turned around, if pricing power comes back and they're able to move pricing up per unit, then I say, okay, now you've got a chance you can actually have operating leverage. A little bit more dollars of revenue drops to the bottom line faster and you'll see cash flow returning. But for the time being, I would not be buying this stock. Let's review the 5 key attributes. Number 1, top line revenue growth. No, I don't think it's growing. Number 2, EBITDA. EBITDA is not growing. Number 3, strong free cash flow. I'm going to say no. Well, I'll say yes. They have strong free cash flow, but the caveat is that cash flow has to go to pay down debt, which is the 4th one. They do not have low leverage. Leverage is too high. Number 5, is it well priced? No, not given the risk of cash flow returning. I'm a pass on the Kraft Heinz. I'm a pass on the Kraft Heinz business. All right. That is Kraft Heinz Company. A quick overview. Again, kind of an issue with leverage. I'd love the CEO to cut the dividend, take aggressive action here on headcount reduction, on brand refresh. Think about the cash they're putting out, $2.7 billion, I think it was, annually on a dividend. If they cut that dividend, if they cut some operating costs out of this, you might be able to scrounge between dividend and savings maybe $3 to $5 billion a year in cash that they could use to go buy other brands that are more relevant and have growth in them. That would be a strategy I would get behind, and a CEO that is taking true leadership in a business rather than someone saying, hey, I'm over leveraged, revenue's flat, earnings are declining, but I'm going to continue paying a dividend out to my shareholders. I think that is taking your eye off the prize. As a fiduciary, that job is there to grow shareholder value, and they're not doing that based on this capital allocation, which you can't see anymore because I'm not sharing my screen, but from $100 billion of value in 2016 for market cap to $37 billion 8 years later. It's a huge erosion of confidence at $70 billion. That's what it's cost the investors by having this poor management. So I would definitely look long and hard in the mirror, guys, and figure this one out. All right, so this is Rational Investing. We're taking a look at Kraft Foods here. Thank you very much. If you like the content, hit the like, hit the subscribe. Always helps. Throw a comment down at the bottom for the old algorithm. And if you like the website, it is cashflowinvestingpro.com. I teach courses. If you want to see how to run Excel like an investment banker without a mouse, I teach you how to do that. If you want to learn how to do this cash flow forecasting on your own, I give you a template. I teach you to read 10Ks. I teach you what market multiples are, how to calculate total debt, leverage ratios, all of that. It's a phenomenal beginner's entrance into investing. I've had hundreds and hundreds of people take that course. I have absolutely loved it, so I highly recommend you take that one. If you don't want to do the work, you can sign up for the Cash Flow Club. It's in the website. We produce one-pagers like this, the analyst and I, and we go through cash flowing companies that we like. Thank you for watching. Let me know what stock you'd like to see in the bottom, and I'm happy to review it. All right, right? Take care. Bye-bye.